Look, everyone is waiting for the big one. You know what I mean, the massive red candle, the 2008 style implosion where the S&P 500 drops 50% overnight and panic sets in. That's what the news sells you. That's what your brain is wired to fear. But what if I told you the crash is already happening? It's just silent. It's not a line going down on a chart. It's the value of the money in your pocket evaporating while asset prices stay flat. Welcome to the economic boogeyman that terrifies the Federal Reserve more than a recession. Welcome to stagflation. So what is it? Simply put, growth is dead, but prices are alive and kicking. It's the worst of both worlds. In a normal recession, prices drop, so cash is king. In a boom, growth is up, so stocks are king. But in stagflation, cash loses value and companies don't grow. It's a trap. Most of you are holding a portfolio built for the last decade, the buy the dip era, the era of cheap money. That game is over. If you look at the 1970s, the last time we saw this beast, the standard 60-40 portfolio got absolutely slaughtered in real terms. It was a lost decade for wealth. So how do we engineer a raft that doesn't sink? We have to stop playing offense and start playing defense. The mechanism here is what I call the barbell strategy. On one side of the barbell, you need things that the printing press can't replicate. I'm talking about commodities, energy, gold. When currencies dilute, gold isn't an investment, it's insurance. It's the only asset that has historically maintained purchasing power when both stocks and bonds fail. On the other side of the barbell, you want short duration yield. Think treasury bills, not long-term bonds. Why? Because in a stagflationary environment, interest rates stay higher for longer. You want to get paid 4-5% to wait, with zero risk of your principal getting crushed if rates spike again. Now here is the trap you need to avoid. Do not chase growth at any price. In a high-interest world, companies that promise profits 10 years from now get repriced instantly. You want companies with pricing power. If the price of raw materials goes up, can this company raise their prices without losing customers? If the answer is no, you sell. If the answer is yes, like essential consumer staples or energy giants, you hold. The payoff? While the herd is panicking because their tech stocks are flatlining and their rent is skyrocketing, your purchasing power remains intact. You aren't trying to hit a home run here. You are trying to ensure that when the dust settles, you're the one with the capital to buy the wreckage. This isn't about fear, it's about physics. The economic cycle has turned. Adjust your sails or get capsized. It's your move.